we can make it as class 42A because it's continuation of PGBP. Chapter 6, PGBP, continuation. There, section 36 subsection 1 class 4, section 43B, section 40A9, section 40A4. These provisions we are going to discuss together. There, assessee is carrying on business or profession. The assessee makes contribution to the provident fund account of employee, makes contribution to the provident fund account of the employee. Obviously, for the assessee, this is an expense incurred in relation to business. This is an expense. If this provident fund is unrecognized provident fund, if it is unrecognized provident fund, this contribution shall not be allowed as a deduction. This is disallowed. This contribution, though a business expense, it is disallowed under 40A9. It is disallowed under 40A9. But if this provident fund is recognized, then the contribution is deductible under 36(1)(4). It is deductible under 36(1)(4). However, this deduction is subject to 43B and 40A4. This is deductible subject to 43B and 40A4. What is the significance of subject to 43B? I'll tell you. Relevance of 43B. Contribution should be deposited into the provident fund account of employee within the due date for filing return for the assessment year relevant to the previous year to which the contribution pertains. Contribution pertains. Contribution should be deposited into the provident fund account of the employee within the due date for filing return of income for the assessment year relevant to the previous year to which the contribution pertains. If it is so deposited, deduction is allowed under 36(1)(4). Deduction is allowed under 36(1)(4) for the previous year to which it pertains, the contribution pertains. If it is not deposited within the due date, supra means above, it is disallowed. It is disallowed for the previous year. It is disallowed for the previous year to which it pertains. It means contribution. And it is allowed as deduction, and it is allowed as deduction only for the previous year in which it was deposited. It was deposited. Contribution should be deposited into the provident fund account of the employee within the due date for filing return of income for the relevant assessment, for the assessment year relevant to the previous year to which the contribution pertains. If it is so deposited, then the deduction will be allowed for the previous year to which it pertains, the contribution pertains. If it is not so deposited within the due date, it is disallowed for the previous year to which it pertains, and it is allowed as a deduction only for the previous year to which, previous year in which it was actually deposited, This is the relevance of 43B. Next is the relevance of section 40A(4). Listen to me. Trustees are appointed by the assessee. Assessee carrying on business or profession offers a provident fund scheme for the employees, and the assessee is only appointed trustees. As appointed trustees to administer the provident fund, set by the assessee. See, when the employee whose service gets terminated will be getting the accumulated balance in his account, will get accumulated balance in his provident fund account. He will get accumulated balance in his provident fund account. The trustees are responsible for making the payment. Suppose the accumulated balance in the provident fund account is not exempt. If it is taxable, the trustees have TDS obligation under 192. We already learnt in TDS chapter. Person responsible for paying has to deduct tax at source. Trustees are responsible for paying this money. So they have TDS obligation under 192. Correct? So the assessee at the time of appointing the trustees should have given direction or instruction for tax deduction, should have given direction or instruction for tax deduction at the time of appointment of trustees, Assessee carrying on business or profession has appointed trustees to administer the provident fund set by the assessee for the benefit of the employees, and when the employee whose services are getting terminated, the accumulated balance in the provident fund account is payable to the employee, and if it is taxable, the trustees have TDS obligation under 192. For that, proper direction and instruction for tax deduction should have been given by the assessee. If the instruction is given supra was given, if the instruction or direction supra was given, then the assessee has made satisfactory arrangement for tax deduction, then only the contributions made by the assessee to the provident fund account of the employees, then only the contributions made by the assessee to the provident fund account of the employee are deductible. Then only the contributions made by the assessee to the provident account of the employees are deductible. If satisfactory arrangement is not made, note, if satisfactory arrangements are not made, if satisfactory arrangements are not made by the assessee, the contributions made by him to the provident fund account of the employee are to be disallowed under 40A4. These are to be disallowed under 40A4. If satisfactory arrangements are not made by the assessee, the contributions made by him to the provident fund account of the employee are to be disallowed under 40A4. So this is the significance. So thus we have completed 36 subsection 1 class 4. 36 subsection 1 class 5A. Read with section 2 class 24 subclass 10. Assessee withholds a sum out of salary payable to employee towards his employee's contribution, towards his contribution to provident fund. Assessee withholds a sum out of salary payable to the employee towards his contribution to the provident fund. Assessee are employer. who carries on business or profession. So, assessee withholds a sum out of salary payable to the employee towards his contribution to the provident fund. Sum withheld is income of assessee, that is employer. This is as per section 2 class 24 subclass 10. Sum withheld is income of the assessee, the employer. And this is attributable to the head PGBP. This is attributable to the head PGBP. Sum withheld is deposited into the provident fund account of employee. Sum deposited withheld is deposited into the provident fund account of the employee within the due date specified in provident fund regulations, which is nothing but 15th of next month. June month contribution should be within 15th July. Within the due date specified in the provident fund regulation, is deposited beyond the due date specified in provident fund regulations. Beyond the due date specified in provident fund regulations, two possibilities. Within the due date, then it is deductible under 36 subsection 1 class 5A. Beyond the due date, this is disallowed, not allowed as a deduction. So this is the second segment we need to note. Next is section 36(1)(5), 43B, 40A7, 40A9, 40 class A, subclass 4. All these things should be studied together. Fine. First, let us take this way. 40A7. Any provision made for gratuity payable to employees is disallowed. Any provision made for gratuity payable to the employee is disallowed. This is disallowed. For that we have exceptions. We have exceptions. That means in some cases there will not be disallowance under 40A7. There exception 1. Employee retires the relevant previous year. Gratuity becomes payable. Provision is created. This provision cannot be disallowed. Provision is created, it cannot be disallowed. Assessee carrying on business or profession, the employer to discharge the gratuity obligation has set up a gratuity fund. He has created a gratuity fund. And listen to me, to this gratuity fund, periodically contributions are made by the assessee. We don't wait for the employee to retire. There are thousands of employees. We cannot leave the gratuity obligations unestimated. Okay, to be reckoned only at the time of retirement of the employee for discharging it. So then there may be liquidity problem. So assessee has set up a gratuity fund to which he is making contributions. Okay. Periodical contributions. To meet the gratuity obligations. To meet the gratuity obligations. Okay. Provision is created by the assessee for making such contribution. Makes provision. Assessee makes provision for such contribution. Then this cannot be disallowed. This cannot be disallowed. Under 40A7, this cannot be disallowed. This is the first provision. Next is we are only telling it cannot be disallowed. We are telling it is to be allowed in solella. We are telling it cannot be disallowed. Next is there is 40A9. What it says, Asas is carrying on business or profession if he is making contribution to gratuity fund which is not approved, unapproved gratuity fund, not approved by the commissioner under the Income Tax Act, unapproved gratuity fund, such contribution, though it is an expense for the assessee, still it will be disallowed. So contribution to unapproved gratuity fund is disallowed. It is disallowed. Next is section 36 subsection 1 class 5. Assessee is carrying on business or profession to an approved gratuity fund assessee is making contribution, periodical contribution to discharge the gratuity obligation. This contribution is an expense for the assessee. This is deductible subject to 43B and 40A4, subject to 43B and 40A4. Relevance of 43B. Relevance of section 43B. The contribution supra should be deposited into the approved gratuity fund within the due date for filing return, within the due date for filing return for the assessment year relevant to the previous year to which it pertains. If it is so deposited, it will be allowed as deduction under 36(1)(5) for the previous year to which it pertains. For the previous year to which it pertains. If it is not so deposited, it will be disallowed under 43B. It will be allowed only for the previous year in which it is deposited. In which it is deposited. The contribution supra should be deposited into the approved gratuity fund within the due date for filing return of income for the assessment year relevant to the previous year to which it pertains. If it is so deposited, there is no problem, we will get deduction. Okay, if it is not so deposited, it will be disallowed under 43B. It will be allowed only for the previous year in which it is deposited. Section 40 class A subclass 4. Relevance of it. Assessee carrying on business or profession he has set up an approved gratuity fund. Sets up approved gratuity fund. Appoints trustees to administer the approved gratuity fund. To administer the approved gratuity fund. Now, employee whose service gets terminated will be getting gratuity. This gratuity is taxable to the extent not exempt under 10(10). It is taxable to the extent not exempt under 10(10). Then the trustees, they do have TDS obligation because they are person responsible for making payment under 192. Okay, so the assessee should have given directions or instructions regarding tax deduction, should give directions or instructions regarding tax directions to the trustees when at the time of appointment if directions or instructions are given directions or instructions given to the employee trustee, given to the trustee, not given. If it is given, contributions made to approved gratuity fund are deductible under 36(1)(5). Contributions made to approved gratuity fund are deductible. Not given, na? Contributions made to approved gratuity fund are disallowed under section 40A class 4. That way you need to understand. When it is given, satisfactory arrangement is made for TDS, so whenever contribution is made, it is allowed as a deduction. Otherwise, it is disallowed. So these are the provisions you need to note. Next is section 36 subsection 1 class 6. Animals are used by the assessee for his business. Animals are used by the assessee for his business or profession. Such animals die or become permanently useless. They have been used to such extent. They become permanently useless. Sold. Such sale results in loss. This loss is deductible. This loss is deductible. Next is (36) subsection 1 class 7 bad debts. This provides deduction in respect of bad debts written off as irrecoverable provides deduction in respect of bad debts written off as irrecoverable in the books of accounts. This provides deduction in respect of bad debts written off as irrecoverable in the books of accounts. Section 41(4). Debt is written off as irrecoverable. Debt is written off as irrecoverable. Deduction was enjoyed under 36(1)(7). Subsequently, it was recovered. Amount written off as bad debts was recovered. It was recovered. Amount recovered is taxed under the head PGBP. In the previous year of recovery, amount recovered is taxed under the head PGBP in the previous year of recovery in view of section 41(4). In view of section 41(4). Next is section 36, subsection 1, class 9. This 36(1)(9) provides deduction. It provides deduction It provides deduction to whom? To companies. The deduction is provided in respect of what? Provides deduction in respect of expenditure on promotion of family planning amongst employees. This provides deduction in respect of what? Expenditure on promotion of family planning amongst employees. Expenditure supra above can be divided into two categories. Space is not there. The expenditure supra can be divided into two categories. Revenue expenditure, capital expenditure, revenue expenditure, capital expenditure. Revenue expenditure is deductible in the previous year of incurrence. It is deductible in the previous year of incurrence. Capital expenditure is deductible equally over a period of 5 years. Over a period of 5 years, starting from the previous year of incurrence. Starting from the previous year of incurrence. It is deductible equally over a period of 5 years starting from the previous year of incurrence. Unabsorbed expenditure on promotion of family planning is treated on par with unabsorbed depreciation. Unabsorbed depreciation. That means it could be freely carried forward for any number of years. No restriction. Next is unabsorbed expenditure on promotion of family planning. Unabsorbed expenditure on promotion of family planning of the amalgamating company could be carried forward and set off by the amalgamated company being an Indian company. Being an Indian company. Unabsorbed expenditure on promotion of family planning of amalgamating company could be carried forward and set off by the amalgamated company being an Indian company. These are all the points you need to remember. Next is section 36(1)(15). If income from transfer of securities subjected to STT. If income from transfer of securities subjected to STT is taxable under the head PGBP, if it is taxable under the head PGBP, then STT is deductible under the head PGBP. Then the STT, securities transaction tax, is also deductible. That is 36 subsection 1 class 15. Then commodities transaction tax is also deductible. The assessee is paying any commodities transaction tax, and that is also deductible. Commodities transaction tax in respect of taxable commodities transactions, in respect of taxable commodities transaction is deductible while computing income under the head PGBP. With this, we are through with section 36. Then the last section in the deductions under the head PGBP is section 37. There, subsection 1. 37(1) provides deduction in respect of expenditure incurred during the previous year. Incurred during the previous year being wholly and exclusively attributable to business. Being wholly and exclusively attributable to business. Being revenue in nature, not being personal in nature, not being one covered by the specific sections of 30 to 36 is eligible for deduction. Under which section? 37(1). Section 37(1). So the expenditure should be incurred during the previous year. It should not be a prior period item. It should be wholly and exclusively attributable to business or profession. It should be revenue in nature. It should not be capital. It should not be personal in nature. And it should not be one covered by 30 to 36. Already covered, now why should it come here? So that you need to note. Note 1. Any expenditure which is incurred for a purpose which is an offense, which is incurred for a purpose which is an offense, or prohibited under any law for the time being in force. Any expenditure which is incurred for a purpose which is an offense or which is prohibited under any law for the time being in force is not deductible under 37(1). This is not deductible under 37(1). So you cannot claim under the pretext of business expense these things as deduction. Note 2. CSR expenses of a company, these are not deductible under 37(1). These are not deductible. Corporate social responsibility expenditure incurred by a company are not deductible. 135 of Companies Act 2013 deals with CSR expenditure. These are not deductible. Then note number 3. Expenditure on advertisement in political magazines are not deductible. It is given in 37 2B. These are not deductible. Wide 80 GGB in chapter 6A. There is one point I have discussed. I don't want to repeat. Go through that. So with this, scheme of business deduction is over. Scheme of business deduction. Now we enter into the disallowance slot. We enter into the disallowance slot. You all know what is disallowance. Under the Income Tax Act, under the head PGBP, certain expenses are not allowed as a deduction. Disallowance provisions are primarily 3 in number: 40, 40A and 43B. 40, 40A and 43B. First section, let us take section 40. In 40, there are 3 classes. One is class A, class B, class BA. There, first let us take 40 class B. A partnership firm pays interest to the partner Obviously, this is an expense to the firm. This is deductible under 36(1)(3) in the hands of the firm. However, it will be disallowed. However, it will be disallowed under 40B if the following conditions are not satisfied. If the following conditions are not satisfied, condition 1, there should be authorization in the partnership deed we will call it as PD for payment of interest to partners Condition number 2, interest shall be paid in accordance with the terms of partnership deed shall be paid in accordance with the terms of partnership deed. Number 3, only simple interest should be paid. Interest rate cannot cross 12% per annum. Cannot cross 12% per annum. So these are the conditions to be fulfilled. Otherwise, it will be disallowed. Next is the firm pays remuneration to the partners. Firm pays what? Remuneration. The firm pays remuneration to the partners. For the firm, this remuneration is an expense. This remuneration is an expense. This is deductible under 37(1). However, if the following requirements are not satisfied, it shall be disallowed under 40 class B. It shall be disallowed under, or if the following requirements are not satisfied, it shall be disallowed under 40 class B. Condition 1. There should be authorization in the partnership deed for payment of remuneration. For payment of remuneration. Remuneration shall be paid in accordance with the terms of partnership deed. It shall be paid in accordance with the terms of partnership deed. Requirement or condition number 3. Remuneration shall be paid only to working partner Next is the aggregate amount of remuneration paid to all partners in the relevant previous year should not cross the ceiling. Next is ceiling. There is one more condition here. No condition, correct. I have covered. Ceiling. Book profit of the firm is negative, it is positive. The book profit is positive. If the book profit is negative, the ceiling is rupees 1,50,000. Remuneration paid to all the partners put together should not cross the ceiling. If it is positive, space is not there. I'll continue in the next page. If it is positive, the book profit doesn't cross 3 lakhs. It crosses 3 lakhs. Doesn't cross 3 lakhs, crosses 3 lakhs. Where it is not crossing 3 lakhs, ceiling is higher of 90% of book profit, 1.5 lakhs, higher up this will be the ceiling. Where it is greater than 3 lakhs, ceiling is 2,70,000 plus book profit minus 3 lakhs into 60 percentage. 2,70,000 plus 60% of the difference between book profit and 3 lakhs. Book profit and 3 lakhs. This is the ceiling. Now you need to know the meaning of the term book profit. Book profit means income under the head PGBP after allowing deduction in respect of interest paid to partners subject to 40B, but before allowing deduction for remuneration paid to partners. Book profit is nothing but income chargeable to tax under the head PGBP after allowing deduction in respect of interest paid to the partners subject to 40B, but before allowing deduction for remuneration paid to partners. This is book profit. With this, we are through with section 40 class B. Next is 40 class BA. Assessee is AOP or BOI. AOP or BOI. Carrying on business or profession to its members if it is paying interest or remuneration this is an expense to the AOP or BOI. Still, it is not allowed as a deduction. It is disallowed under 40 class BA. It is disallowed. Fine. Next is 40 class A. There already we have covered something. These are all covered, I'll tell you. 40A 1, 1A 3, 4, 5. These are all already covered. No need to discuss them. Covered already. What is still remaining is 48 2B. Only these two are remaining. Everything is covered. There. Next is $48. Any tax levied in India or outside India on profits and gains from business or profession is disallowed. Income tax is disallowed here. Any tax levied in India or outside India on profits and gains from business or profession is disallowed. Next is 40A 2B. Where a state government undertaking assess here state government undertaking to the state government, if it is paying royalty or license fee, service fee, privilege fee, service charge, etc. These are all disallowed in the hands of state government undertaking, not allowed as a deduction while computing the business income of the assessee. With this, our discussion on 40 is over. Now we enter into section 40A. In 40A also, we have covered some provisions. Subsection 7, we have already discussed it. Subsection 9, these two are already covered. These two are already covered. So what is not yet covered is subsection 2, subsection 3, subsection 3a, subsection 4. These we will cover. Yet to be covered. There first is section 40A2. As he is carrying on business or profession, as he is carrying on business or profession. There are connected persons to the assessee. From such connected persons, assessee purchases goods or from these connected persons the assessee is avails services or facilities for which the assessee gives consideration. And such consideration is found to be excessive, or unreasonable. It is excessive or unreasonable, having regard to the fair market value of the goods or services. Having regard to the fair market value of goods or services. Then the excessive or unreasonable portion, the excessive or unreasonable portion could be disallowed under 40A2. Sorry. Who are connected persons? For an individual, his relative is connected person. For a firm, partner is connected person, his relatives are connected persons. For a company, the director is connected persons, the relatives of the directors are connected persons. Like this, a list is available. I have included in my typed notes. It doesn't require it is included in the study material. It is in the study material. Institute study material, who are all connected persons given. Go through that. It doesn't require my support. For meaning of connected persons, see ICAI study material. ICAI study material. Fine. The next area of discussion is 40A3, 3A, 4 and Rule 6DD. This is the next chunk. There, first let us take 40A3 for a discussion. An expenditure which is otherwise eligible for deduction under the head PGBP. An expenditure which is otherwise eligible for deduction under the head PGBP could be disallowed if the following cumulative conditions are satisfied. If the following cumulative conditions are satisfied, an expenditure which is otherwise eligible for deduction under the head PGBP could be disallowed if the following conditions are satisfied cumulatively. Condition 1, the expenditure exceeds 10,000. Number 2, payment in respect of such expenditure in a day, payment in respect of such expenditure in a day crosses 10,000. Number 3, payment is made otherwise than by way of account payee check, account payee bank draft, or by way of electronic clearing system through bank account, or any other electronic mode as may be prescribed. Payment is made otherwise than by way of account payee check or account payee bank draft or electronic clearing system or by any other electronic mode. It is not paid in these modes. The transaction is not immunized under Rule 6DD. It is not immunized under Rule 6DD. If these requirements are satisfied, then it will be disallowed. It will be disallowed. Fine. Illustration 1. Illustration 1. Asahi A Limited purchases raw materials from the supplier okay. Invoice, date of purchase, amount. Date of purchase 20th June. Invoice 110/2019. Amount 80,000. 115/2019, 30th June 2019. 7,000. Two purchases are made. A Limited has paid rupees 15,000 in cash on 3rd July 2019. On 3rd July 2019, 15,000 in cash it has paid. Inge section 40A3 doesn't come. No disallowance. Reason, though payment in a day in cash exceeds 10,000, the expenditure for which payment is made is not crossing 10,000, doesn't cross 10,000. So that is the reason for not invoking 40A3. Not invoking 40A3. Next is illustration number 2. Illustration number 2. Asahi is X Limited raw materials worth rupees 50,000 purchased on 3rd June 2019. Purchased on 3rd June 2019. Payment details are as under. Date of payment, amount paid, mode of payment. These details are available. First payment is on 5th June, 10,000 cash. Next payment on 8th June, 10,000 cash. 10th June 2019, 30,000 balance, account payee check. A3 will not come. No disallowance. Because payment in a day has not crossed 10,000. Payment in a day has not crossed 10,000. Next is note. In case of payment made to transport operators for plying, hiring or leasing goods carriages, the threshold limit is not 10,000 but it is rupees 35,000. But it is rupees 35,000. Next is section rule 6DD. For the following payments, section 40A3 can't be invoked. Even if the payment is made in cash, 40A3 can't be invoked. for the following payments, 40A3 can't be invoked. Can't be invoked. Number 1. Payment to RBI, payment to banking company, payment to SBI, payment to cooperative banks, payment to land mortgage bank, payment to primary agricultural credit society, primary agricultural credit society, payment to LIC or payment to government. These are all outside the ambit of 40A3. The mode of payment is irrelevant, no question of making a disallowance. Payment made by letter of credit arrangement through bank. Payment made by letter of credit arrangement through bank. Payment made by mail transfer or telegraphic transfer. Debit card, credit card, electronic clearing system, NEFT, RTGS, etc. No issues. Payment made by bill of exchange, bill of exchange made payable only to bank, made payable only to bank. Okay, for this also 40A3 will not apply. Payment made through bona fide book adjustment. Payment made through bona fide book adjustment. If I owe you 10 lakhs, you owe me 8 lakhs. Okay, I adjust this 10 lakhs against the 8 lakhs to the extent of rupees 8 lakhs and give you balance 2 lakhs. This is book adjustment, bona fide book adjustment. No problem. I purchase from you raw materials worth 10 lakhs. You already owe me 10 lakhs. I don't give you 10 lakhs. So you owe me 12 lakhs. I purchase raw material from you worth 10 lakhs. I don't pay you 10 lakhs. I adjust against the amount which you owe me. Correct? This is bona fide book adjustment. No problem. Next is payment made for purchase of a agricultural or forest produce or the produce of animal husbandry, produce of animal husbandry or produce of dairy or poultry farming fish or fish products fish or fish products then products of horticulture cultivation of fruits and vegetables to whom to the cultivator or grower or producer to the cultivator grower or producer you are making payment not to middlemen to the cultivator grower or producer you are making payment no issues you can make payment even in cash you are procuring the rice or paddy directly from the farmer you are making payment in cash no problem okay so to the cultivator grower or producer you are making payment directly no issues